Hello there, welcome to The Open here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. China's ambassador to Canada, Wang Di, is urging Ottawa to move fast and make progress on areas of collaboration between the two countries that were agreed to during the Prime Minister's visit to Beijing last week. During that visit, the Chinese President Xi Jinping and Mr. Carney agreed to resolve a tariff dispute that had seen Beijing put levies on agricultural goods from Canada in retaliation for Ottawa's tariffs on electric vehicles from China. Toys R Us Canada is facing at least 7 lawsuits from landlords who say they're collectively owed more than $30 million in unpaid rent and damages. So these landlords going after the struggling retailer. Documents filed with an Ontario court last year claim the toy store chain failed to pay rent for several of the properties it occupied in 2024 and 2025, sparking lawsuits. The spaces were owned by landlords Rio Trin Properties and Callaway Real Estate Investment Trust. TikTok will be able to continue operating its subsidiary in Canada for now. That's with the government's blessing after a judge shelved a previous order for the service to wind down. In November of 2024, under the former Prime Minister, Mr. Trudeau, Canada ordered ByteDance to close its subsidiary TikTok Technology Canada. But yesterday, that order was set aside by the federal court after a motion by the federal government in TikTok's appeal. And it does look like we're going to get a higher open for U.S. stocks. Investors were relieved yesterday after U.S. President Donald Trump backed away from his threat to use military force to take over Greenland. He says a deal has been struck over the sovereignty of Greenland that gives America some kind of control, but the head of NATO is disputing that. And let's have a look at how the TSX traded yesterday. It got a boost, of course, from gold stocks. We'll be talking more about them shortly. Gold stocks hitting record highs as bullion did the same. And let's check in on oil. It's down today. It rallied yesterday on the prospect that these tariffs that Trump has threatened on European nations over Greenland are off the table for now. And let's have a look at gold. Speaking of bullion, and gold in record territory, just slipping slightly today. Look at that, though, up almost 75% in the past 12 months. And finally, the Canadian dollar. Let's see how that's doing. And once again, it's gaining ground on the U.S. currency. And let's have a quick look at Bitcoin, if we have time. Seen as a measure right now of investors' appetite for risk. And it is slipping a bit today, below that psychological 90,000 mark. Let's put up a one-week chart for the S&P 500. Investors breathed a sigh of relief yesterday after U.S. President Donald Trump backed down, or at least softened, his threats to impose tariffs on European countries who don't support a U.S. takeover of Greenland. Our guest has some ideas for your portfolio. Joining us now, Garnet Anderson, VP and Head of Portfolio Management at Tacita Capital. Great to see you.
Good morning.
So it does look as though the market was relieved that Trump doesn't plan an invasion, whether that was ever on the cards.
Whether it was ever in the cards, and what happened the last 24 hours, and to your earlier point, one side said there's a deal, and the other side said there's not a deal. Denmark's got something to say about it. The cages are still being rattled. You can see why gold, yes, it's off a little bit this morning, but it's not as if it's dropped $50 or what have you, sort of thing. So geopolitical risk is still front and center. I mean, lost in the background, you still have Ukraine, Russia going on. You still have friction with China. You still have the situation in Israel, Gaza. So it's still a world that is fraught with risk, and I think that's coming through in the price of gold, and certainly in gold producers.
Yeah, I mean, Trump has got all these pots on the boil. Confrontation with Iran, he scooped up the leader of Venezuela, but seems to be happy with leaving the regime in place there.
Right. Well, interested the final reconciliation of the oil revenue versus the oil revenue that went back to Venezuela and what was scooped, and what that does long-term to energy prices. Certainly has a high activity level, but a lot of the activity level, again, is stoking concern around the world, which is good for precious metals.
What has a high activity level?
Well, if you think all the things, to your point,
Yeah.
Trump is right, left, and center in terms of going at Venezuela, talking about Mexico, talking about Canada, talking about Greenland, Iran, his peace group. I mean, every day it's a wake up and it's like, okay, who's the target today and what's the methodology? And so that keeps people on their toes. And when people get anxious about that, they think, okay, where can I go to for safety? And some will certainly go over into bonds, but then even with those that start to worry a little bit about treasuries, I think that's overdone. U.S. treasuries are still U.S. treasuries.
Yeah.
But there will be protest selling to a degree. We saw that out of the Danish pension group sort of thing. But I think that will be fairly minimal, all things considered. And so again, you kind of go, okay, well, what are quality equities that can withstand some challenges? Which ones have moats, so protections around? Which ones have some yield? Usually we're not huge yield-oriented investors because a lot of the capital we manage is taxable, and we prefer to have capital gains realized years down the line. But when you get to unrestful times, having a little bit of income coming into the portfolio, which is more stable than share prices, that can help, calm down a portfolio as well.
Maybe we could have a look at the yield on the US 10-year bond, because of course you'd expect that to really spike if there was a wholesale retreat from US treasuries.
Well, yes, you certainly would expect it to spike on that basis. And then if there was going to be another conflict, they get expensive, that drives up inflation more. Does that then move up? The other thing that will affect that, or could potentially affect that, we still have the change in the Fed coming down the pipeline. And, it's one thing to do with short-term rates, and that's where so much of the focus goes. But what they're doing with their balance sheet is key, because that's almost more what affects or can adjust what's happening at the longer-term rates, which affects business borrowing, which affects mortgages stateside and home ownership and so on and so forth. So it is that risk that permeates through, could be short-term, which would drop rates, but there's true risk, to your point, be the longer-term rates that could spike and then self-inflict pain on the U.S. consumer.
We got some jobs data out of the States today. What do they tell you?
Pretty milquetoast, all things considered. Jobless claims were about 200,000, a little bit below expectations, a little bit higher than the prior week. When you take a look at on a rolling 4-week basis, again, fairly docile. It's settled back in. We're kind of in that no hire, no fire kind of motif out there. On the no hire, you've got, again, the geopolitical risk, the tariff concerns. You've got AI. Do you go out hire 5 people, or do you make an investment and try to get efficiencies that way? And on the other side, companies still remember, that skilled labor can be difficult to get by, come by. Don't get rid of it too quickly coming out of COVID. And so there still is not massive fire. So you take a look at the challenger jobs, for example. December is usually light. You tend not to announce mass layoffs in December. But even coming into October and November, you could see that retreating. So it's just everybody's kind of staying pretty close. And then you've got the unemployment rate stays relatively stable stateside, because you also have people that are leaving the job market.
You have a couple of stock ideas for us. Brookfield Infrastructure.
Yes, it comes back to the comment around yield. Now, we've had Brookfield Infrastructure in our real asset portfolio from the get-go. We've had it at an overweight position. We always looked at it as like an all-in-one infrastructure play. And that's from transmission, electrical, from gas pipelines to cell phone towers to now data centers, the backstop. So if you want a little taste of the AI play, but you don't want to get into the hyperscalers, these are the providers behind. And what you get there, you get very dynamic management. They recycle their capital. They are dating. They're not marrying their underlying investments. And they're not going out and raising a bunch of capital, so they're not diluting out the stock. They've managed to increase their dividend, call it 8-9% per year sort of thing. So that's pretty strong. This year compared to last year for the third quarter, they turned a negative or a loss into a gain. So very much positive. They've got their earnings coming out next week. And if they're able to put up another surprise, I think there could be a little bit of energy behind it. Because purpose, all things considered, it hasn't knocked the socks off of its stock price. It's not one of these stocks that has just rocketed higher. When you take a look at valuation levels, it's not sitting up at the 95th percentile of its historical valuation metrics. So it could have some room, but regardless, it is a long-term hold in our portfolio. We recognize that there can be downside. Just like many infrastructure companies, they come with debt. And when people get anxious about debt or the economy, you do see some sell-offs there. So it's nothing that you would go absolutely crazy about, but a good solid position in Canadian portfolios.
Garnet, thank you very much indeed. Garnet Anderson, Vice President and Head of Portfolio Manager at Tacita Capital. Up next, we'll get the latest on Trump departing Davos just hours after backing off threats to take Greenland by force and scrapping plans to slap trade levies on European allies. We'll be right back. Okay, so U.S. President Donald Trump has reversed course on his threats to take over Greenland. He also says there's a future, or the framework of a future deal in place with respect to Greenland and, he says, the entire Arctic region. He also backed off on threatened 35% tariffs on EU nations that opposed his threats to take control of the Danish territory. Okay, well, let's get more from our colleague Scott Hurst at CTV News. Thank you very much, Scott.
Good morning, Andrew. Really a dramatic shift in tone, at least for now, from starting the day demanding that the U.S. must acquire Greenland and threatening tariffs, as you mentioned, on countries that stood in his way, to then announcing a framework for a deal for Greenland and, as you mentioned, for the entire Arctic region. But no more direct talk of ownership and no more tariffs on several European countries. We know little right now about the specifics, but Trump has suggested it could mean more troops, more bases, and a greater presence on Greenland, as well as additional discussions about the Golden Dome defense system, with Greenland being a key part. It could also include greater access for the U.S. to critical minerals. But this change in tune, the dramatic reversal, coming after a sit-down with NATO chief Mark Rutte. So at the time, no more talk about ownership. Trump ruling out military intervention at his speech in Davos. But what happens if these negotiations don't go well? Could he shift back to the threat of tariffs? And could he shift back to talk of owning Greenland? This is all a very realistic possibility. Trump now has instructed Vice President J.D. Vance, Secretary of State Marco Rubio, and Special Envoy Steve Witkoff to lead the charge in the negotiations, and reportedly will report directly back to him, Andrew.
So really a day of drama yesterday. Trump, of course, making a long speech at Davos, the World Economic Forum gathering. So give us a little bit more on this claim by the president that the deal, or the framework deal, will swallow up the entire Arctic region. Is there any implications here for Canada's Arctic sovereignty?
There are 8 countries with territory in the Arctic, including Canada, of course. 7 of them are NATO members, excluding Russia. And talk of Arctic security is often framed around threats from Russia and from China. And we have heard from NATO members, including Canada, agreeing that a stronger presence is needed in the Arctic. And also, Mark Carney did meet with the chief of NATO before Trump did, and the two reaffirmed the commitment that the future of Greenland should be decided by Greenland and Denmark, but also there should be an acceleration of new investments in the region to help secure the Arctic from those threats, potentially from Russia and China, including from the Canadian perspective, specifically Arctic over-the-horizon radar, which can conduct surveillance at far greater ranges than regular radar technology as part of regional defense. Also from Canada, year-round presence across land, air, and sea, and new critical infrastructure, with the Prime Minister coming out of that meeting with the NATO chief also highlighting Canada's mission to quadruple defense spending over the next decade. So Canada is very much part of the conversation and part of the discussion with other NATO allies about increasing security in the Arctic.
Okay, thank you very much, Scott. So much going on. Scott Hurst of CTV News. Up next, we are going to hear from the Ontario Teachers Pension Plan CEO following those contrasting speeches from Mr. Trump and Mr. Carney at Davos. The Ontario Teachers Pension Plan CEO, Joe Taylor, says that the giant investor has cut exposure to the US dollar and US bonds. He spoke to our Bloomberg partners on the sidelines of the 2026 World Economic Forum in Davos. They began by discussing his views of Carney's speech at the summit.
Well, in Canada, we're trying to do a few things. Clearly, we need to diversify, trade particularly. I think also he is trying to align with the European countries as well as some other countries in terms of trying to put up a fairly robust approach towards NATO, Greenland as it was at that point. You know, to me, what we're trying to do is reinforce some old characteristics of, you know, we work with people in a collaborative fashion to try and make the most out of the opportunity. Very similar to what we do at Ontario Teachers. I mean, we've got a long history, as you know, of 35 years of working with partners who actually have particular expertise and skills that they can bring to the table with us. And whilst we invest on our own, we can always learn more and learn from smart people who are in the country and know how to navigate.
Well, let's talk about how you're navigating the United States at the moment. Have you been diversifying? Have you been cutting your dollar exposure, hedging it? What have you been doing?
Now, you asked me this question a year ago, so I wanted to make sure I'm actually on point. So we did make some adjustments to the US. We thought we were a little overexposed to the dollar and actually probably a little overexposed to US Treasuries. So we cut them both. But, you know, the right corrective message is the US is still 30%, 35% of our portfolio. It's probably about 30 at the moment. And it's always going to be an important territory for us for further capital.
When did you cut the exposure, and what was the main driver of it?
Well, we saw personally that there was probably more risk of a deflationary dollar. So we cut it in probably Q1 last year, and we've sort of kept it at a similar level since then. You know, the really interesting thing is, you know, our business is a mix of investing in great private companies as well as investing in listed markets. So as we've started to realize some of our private portfolio, which we did very successfully last year, where do you put that capital? So actually what we tended to put it in is more of a sort of a benign but liquid public format. And then you get the equity weighting, which is actually quite strong towards the US. So to some extent, you always tend to get a little bit pulled back to that territory.
Okay, there's a lot to unpack there. On one hand, the idea that you are getting cashed out of the private equity holdings or the private assets and that you're putting it into public markets is really interesting. How much is that a path of travel for you, moving away from private into public? Right.
So there's a headline I should probably course correct straight out the gate, which is to say private markets has been a hugely successful part of our business, is still very much a core activity. You know, like any investment company, we should say we're not asset collectors. We try to acquire companies, build them, make them successful. If somebody comes along and says we'd really like to buy them and give us a good offer, then we'll tend to monetize them. So if you come back to what we were doing last year, probably our biggest realization was actually selling our airport portfolio of 5 airports in and around Europe. But we also sold some private equity assets, as you rightly pointed out. But our plan is to reinvest that capital. So the point, I would say more as a direction for us, putting that money into liquid form in public markets is we're really just warehousing it till we know where we want to redeploy it given our view of teachers wants an all-weather portfolio, which can be a very resilient entity in difficult times. We've been seeing some of that recently, and it stood up really well to those challenges.
How much is your portfolio tethered to the AI trade?
The AI question always tends to arise somewhere in the discussion.
Well, the entire promenade for Davos has the company name .ai, something AI, come in because we're doing AI.
Exactly right. So from an investing point of view on AI, I'm not sure we're necessarily the same as all. So we're probably more in the mode of we're not sure every AI business is going to be successful. We're not sure the larger businesses are automatically the ones that will win over time. And we're trying, therefore, to be careful, selective, and the danger of that is, do you make the right choice in terms of who you go with? The other thing for AI for us, which is really important, is how it's impacting our existing portfolio of companies we already own. So how do we enable them so that they actually use AI themselves to be advantaged rather than sort of a disadvantage by AI hitting them? And also we've got our own business, which is how do we use AI to actually make better choices using the data we have.
Do you feel good about SpaceX and Anthropic?
Yes, broadly. We own both of them, as you know.
Yes.
I'd say we feel Anthropic's an interesting AI investment under the description I just gave you. I mean, let's be honest, SpaceX has been a fabulous investment for us.
They're going to IPO.
Well, it may IPO, but even if it doesn't, we've seen, I think everybody gets a little bit fixated on the market capitalization that's being discussed. I would go back to SpaceX and say there's a business that's done excellent execution around engineering, launching, hitting their milestones. It's the dominant business in space at the moment, and they've done a super job of actually making sure they delivered everything on time and broadly with a very cost-aware analysis of what they do.
We're speaking to Adina Friedman of the NASDAQ a little bit later on. And I think a conversation we might have is what happened to the stay private forever story? Because now we're talking about exits. Is there something about the size of the companies we're talking about, SpaceX, Anthropic, whoever it might be, OpenAI, whereby actually the natural evolution of a company still is ultimately you get big enough, you go public?
Well, that's sort of been the way. What I would say is a couple of maybe contrary views.
Please.
Is firstly, the IPO window, as we all know, isn't open for very long, very often. So there's really a question of does it actually match your timing and you're able to do it when you need to do it. I think the other thing is actually, what's the mood of existing sort of institutional investors in IPOs to say, how would you want to value this business and what sort of discount would you want to be able to come in at the right price? I would say we've had lots of really interesting conversations with companies that being an alternative to an IPO because we can provide long-term patient capital, which actually allows them to grow further, but doesn't necessarily mean they have all the issues around disclosure, around things that come with being a listed company. And for some businesses, the amount of disclosure you're asked to make can actually be a little bit challenging in terms of what your competitors can learn about your activities.
We're counting down to the opening bells on the Open. Thanks very much for tuning in. And there you have it, the opening bells on Bay Street and Wall Street. At the NASDAQ, Medicus Pharma is doing the honors. At the New York Stock Exchange, BitGo is celebrating its initial public offering. And at the TSX, Evolve ETFs is marking the new listing of Evolve Big Six Canadian Banks Ultra Yield Index ETF. It's time for the first 50. Thanks so much for tuning in today. Let's have a look at the markets as we get going. On this Thursday, the TSX not far off record highs, just over 33,000. Let me just check if we are setting a new high water mark. Stocks, though, moving up again amid relief that President Trump has backed off from his threat to seize Greenland if necessary. So Toronto's still marginally down from its close of 33,090 on Monday. And there is the S&P 500 also moving higher in early trading. It's in record territory, but not quite back to the record close of 6,977 on Monday of last week. So it's only about 50 points down from that. A few stocks on our radar. Lululemon. The founder, Chip Wilson, has been an aggressive critic of the company over the years. He's lashing out over a product flop. It's not the first time Lululemon has had trouble with new products. He's calling it a, quote, total operational failure. It's a new low for Lululemon, he said on LinkedIn. The problem involves these Get Low leggings, which have drawn complaints for being see-through. I think that happened quite a few years ago as well. They launched some leggings and people said they were too revealing. Now, Lululemon halted online sales of the line amid internet complaints, but it is still apparently available in stores. And we're also watching Cargojet. Raymond James is increasing its price target on Cargojet to $120. That's up $25. It says there are key indicators supporting a tightening North American air freight market. One tragic incident was in November. There was an MD-11 cargo freighter crashed in Kentucky. A dozen lives were lost, and the FAA, the American aviation regulator, grounded all MD-11 aircraft. And Ray James says that sliced out a whole bunch of industry capacity overnight. And let's check out some stocks trading in south of the border. Mobileye, under pressure. Maker of software and hardware for autos, provided revenue forecast for 2026 that missed estimates. And Procter & Gamble, let's have a look at this classic consumer products giant. Key sales or growth in a key sales metric was flat in the latest quarter, and volume was down, indicating that U.S. consumers spend cautiously in the final months of the year. Coming up, we're going to get some ideas on where tech stocks may be headed to in 2026, and we'll get some equity ideas potentially for your portfolio. We're soon going to be getting earnings reports from tech giants, with the likes of Meta and Microsoft set to report next week. Let's get perspective on how to play tech stocks this year from Jamie Murray, president of the Murray Wealth Group. Thanks very much indeed for joining us, Jamie.
Thanks for having me.
What themes will you be looking out for in the earnings from these tech companies?
So we're really moving from the early adoption of AI, which was chatbots, ChatGPT, a lot of focus on training and creating these models, to now moving to the inference phase, which is running the models, maybe agentic commerce, bringing that into an enterprise setting. And every time we see a new adoption, a new tool, a new use case, that just creates additional demand for these tools. And so we have new chips from NVIDIA coming out this year that are going to be much more powerful than what we saw last year. It's also going to be much more cost effective to run these models. And so we think we're going to see a continued explosion of growth in the inference market. And that's going to be great for the hyperscalers like Microsoft, like Amazon, Alphabet as well, who own a lot of the infrastructure and the application layers that will allow corporate America and corporations around the world to run these products across their organizations.
Do you think, though, the traditional software companies, I'm thinking about Constellation Software or an Adobe, will they still be under a cloud?
I think so. I mean, Microsoft has a lot of software embedded in it, and we're really now learning what is the differences between all these software companies. If it's a pure SaaS-based desktop software company that is used by employees across an organization, or a software like an Uber that's integrated into a physical marketplace and a physical network. I think we're seeing some bifurcation in that. So it really is going to be a stock picker's market in the software industry. I don't believe in my gut that software is dead, but I certainly think there's some real headwinds across different parts of it. I mean, Adobe's, I think, a great example. It has very strong lock-in with its core developer market and core, the photographers out there, the media buyers. But there's a lot of low-hanging fruit in terms of generating charts and generating images that now we, base users can do for free on ChatGPT. So it's a small headwind. I don't think Adobe over the long term is going to be significantly disrupted, but it's certainly going to probably continue to make noise and headlines in 2026.
I guess the high-end users will need Adobe tools, but for the rest of us, you can do pretty amazing stuff with ChatGPT or Copilot.
Yeah, exactly. I mean, we're seeing similar even on a Salesforce, so CRM. Some companies use their Salesforce and CRM just to really store and organize all their, client and sales data and prospect data. And now with some chatbots and some ChatGPT APIs, an enterprise could build that functionality more tailored to what they need. But then there's a whole other level of Salesforce usage that's deeply embedded in the organization, is connected to other systems. So there's a plumbing effect that some of these software companies have where they're connected to multiple systems across an organization. And that's going to be very, very hard for AI to disrupt in the short term to medium term.
Just swinging over to Davos here, you reckon that this to and fro over Greenland is another example of Trump's bark being worse than his bite?
Yeah, exactly. So we often have clients phone us up and say, Trump's at it again. Is this going to be bad for the markets, or should we reduce our risk to the U.S.?
Yeah.
Our view is that this isn't really an upending of the last 60 years. It certainly is a different tone out of the U.S. And the U.S., I think, is certainly poking and prodding other NATO members and its traditional allies to move more towards U.S.-centric goals versus maybe its own nation goals. And so they're applying pressure in unconventional ways and not necessarily diplomatic ways, which is a big change. But ultimately, I think the U.S. just wants Greenland to be secure. So there's a strong, line from Europe right across to Alaska. And that's why we're seeing Canada talk a big game about Arctic investment. And we're not hearing the U.S. really criticize Canada too much on that aspect. Also, the UK has a pretty strong defense program as well, and we're not hearing Trump go after them. So it's really this Greenland piece where I think the U.S. is saying, if you're not going to secure this, then we will. But ultimately, as we saw, they came to an agreement. I think the U.S. is getting what it wants from this agreement, and so we think, again, he'll apply pressure where he can, and try and push for U.S.-based goals. And there's no real downside for him to do that.
You've got a few stock ideas for us. Exchange Income Fund, EIF, Jamie, that's a stock that you're holding right now. What attracts you to it?
Yeah, this is one of our largest holdings in our income fund. And, we like its diversified business model, but we really like its Northern Canada aviation assets. And so speaking of Greenland and securing Greenland and, making sure that Russian and Chinese submarines or boats or aircraft are not coming into those waters. I mean, that plays right into Exchange's strength. They actually do intelligence and surveillance off the coast of Greenland. So they're already contracted there to do this type of work. We're going to see more of this in the Arctic in Canada, where Exchange dominates the aviation market, sort of north of Winnipeg and up through Nunavut. So we think there's going to be tons of opportunities for Exchange to grow this business. The market's starting to realize that, and we're starting to see the stock re-rate from being maybe more of a manufacturing type company towards that higher end defense multiple that some companies get. Because a lot of these contracts they earn are fixed margin. There's not a whole lot of risk in terms of the amount of money they'll make. It's just about them being able to execute it.
Major Drilling, MDI, they provide drilling services for miners all around the world. You see potential there. I guess the copper mania is going to be good for them.
Yeah, copper mania, gold mania is possibly even better. And what is really attractive about this company, it's obviously had a nice move in the last year. If you had a 5-year chart, kind of traded between 7 and 12 for 3 or 4 years, and now it's moved up to close to $15. But this is a company that when the mining cycle really gets going and all this exploration money that was raised through 2025 and all the cash flow that the big seniors and intermediates are making right now, eventually they're going to deploy this back into the drill bit, back into exploration spending. Also, before you build a mine, you have to do lots of drilling to define the entire mine pit to optimize the mine plan. And so we think this is a company that has a great 3 to 4 year outlook. And just what we're hearing anecdotally is, the rigs, and especially in terms of the labor supply, in 2026, we might see shortages of available rigs and labor to do these drill programs. And so, that's just good for margins, good for pricing. And, we think this is a stock that could have a big year in the next 12 months.
And finally, Northwest Healthcare, you're getting a yield of about 6%. You say this is your favorite REIT?
Yeah, we think this is a great opportunity to acquire Northwest Healthcare. The REIT is starting to move on some better marketing and better communication from the new management team that was brought in the last couple of years. And this is a stock that we've owned for 3 or 4 years. We've been following along as they went through a bit of a restructuring. They had to sell off a lot of assets to pay down debt. They now have the balance sheet under control. They're issuing debt at investment grade ratings. And I mean, they own hospital assets and other healthcare assets. It's very economically defensive. And what we like is we met with the company a couple of weeks ago. They're finally back to the point where now they're back into acquisition mode. So they're starting to acquire some assets. And we think when the market starts to wake up and sees that it's growing again, that this is going to be a company that is on the radar for a lot of real estate investors.
Jamie, we'd better leave it there. Thank you very much indeed for joining us.
Yeah, thanks for having me.
Jamie Murray, president of Murray Wealth Group. Yesterday on Market Call, we were joined by Eric Nuttall. He's a partner and senior portfolio manager at 9 Point Partners. Of course, he was covering energy stocks. His top ideas were Expand Energy, EXE on the NASDAQ, EQT Energy in the New York Stock Exchange, and Antero Resources, AR, in New York. Interesting that his top picks were all U.S.-listed companies. Today on the show, it's Javed Mirza, quantitative technical strategist at Raymond James, and we'll take your questions on technical analysis. Just ahead, the Prime Minister is meeting with his cabinet today. There's a lot to talk about after his trip to Davos, but also his trip to China. This will be the first chance that ministers will have to hear from the Prime Minister about that trade accord with Beijing. We'll be right back. The Liberal cabinet is meeting in Quebec City today with meetings set to focus on the economy, affordability and security. These come after the U.S. president called out the Prime Minister, Mr. Carney, in Davos, as saying, remember that, Mark, Canada lives because of the United States. This gathering presents the first chance for the cabinet to hear from the Prime Minister about his new trade accord with China and change in relationship with that regime. We're joined for more by CTV's Jeremy Sharon. Jeremy, thanks very much for giving us the time. Plenty for the Prime Minister to discuss here with his cabinet.
Yeah, absolutely, Andy. This will be, what this government is calling a planning forum. We used to call these cabinet retreats, but a cabinet planning forum is what they're calling this. But to your point, an important first opportunity for the Prime Minister to meet with his cabinet and address the last 9 days abroad, his trip to China, to Qatar, to Switzerland, where, he signed that new trade deal, as you've touched on, that will allow for more EVs, Chinese-made EVs, to gain access to the Canadian market, 49,000 a year, while Canadians and the Canadian canola industry is going to see a reduction on tariffs. So the first opportunity for the Prime Minister to talk to his cabinet about that. And what we've also heard from the Prime Minister's team is this is a meeting that will focus a lot on the priorities that were set out in the that were set out early on by this government for the cabinet. And chief among those things that this government has set out as priorities is an economic and security relationship with the U.S. and bolstering relationships with other like-minded countries. Exactly what we've been seeing the Prime Minister do for the last several days. So we'll hear a lot of talk, I think, about the economy, about the new deals that the Prime Minister has signed, but also what we can expect moving forward in the relationship with the U.S. Of course, CUSMA renegotiations are underway now, so that will be a focus. But to your point, Andy, there will be a lot of talk as well and many questions about the Prime Minister's speech at the World Economic Forum that has gathered global attention, praise from some world leaders. Donald Trump clearly not a fan of the speech, criticized the Prime Minister over it, reminded Prime Minister Mark Carney during that speech in front of the crowd that he believes Canada lives because of the U.S. So a first opportunity today, we'll hear from the Prime Minister at 1 o'clock, a first opportunity to perhaps get his reaction to U.S. President Donald Trump's comments about his speech that garnered so much attention at the World Economic Forum.
I was looking at global coverage. CTV touched on this yesterday. Newspapers around the world, some of them saying that Mr. Carney is leading now the response to what people call Trumpism.
Yeah, absolutely. He seems to have, through that speech in Davos at the World Economic Forum, garnered the attention of leaders around the globe for saying what many have been thinking, but not saying out loud, right? And recognizing that things have changed and that there are new realities that Canada has to deal with. That was his perspective that he offered in that speech in Davos, and especially focusing on the fact that we, Canada, as a middle power country, as he talked about it, and other middle power countries need to kind of work together and recognize that other countries like the U.S. that are far more powerful have shown recently that they have the ability to do what they want to do. So, to your point, Andy, many around the globe have kind of identified that the Prime Minister, they believe now Canada's Prime Minister, is leading the charge in that discussion, in what is now a new reality, in dealing with a superpower in the U.S. that is just not operating the same way it has for decades, right?
It really is incredible. Yeah, Mr. Carney talking about a rupture, not a transition. Jeremy, thank you very much indeed. That's CTV's Jeremy Sharon, our colleague at CTV News. Okay, we are going to take a look at some stock movers, including Lundin Mining cutting its production forecast. Investors were not delighted in early trading. Welcome back. Let's check in on the TSX. It moved higher in early trading in tandem with U.S. stocks because there is relief that Trump has backed down on his most dire threats to potentially launch an invasion of Greenland. Apparently at Davos, executives were texting, according to the New York Times, taco to each other. Let's have a look now at some stocks of interest. We've got Lundin Mining under pressure right now. That company is a base metal specialist, but it produces a fair amount of gold as well. And it's cutting its gold output forecast for this year. It sees production now as low as 134,000 ounces. So it's not a vast gold producer by any means. The estimate was almost 149,000. And it sees copper production as low as 310,000, slightly down from the previous level. But the estimate was almost 336,000 tons. So it's a significant copper producer, 1/3 tons of copper every year. Another stock of interest here is Celestica. Now, TD Cowen's John Shao is saying, this is a hold. It has a solid business and a management team. However, the analysts cautioning the risk here you're taking on if you buy the shares is investor sentiment is probably going to be linked to broader swings in artificial intelligence shares. Sure, the company in an ideal scenario with its continuously improving financials should do okay. Quote, though, realistically, we believe Celestica trade is intricately tied to the broader AI trade, which exhibits increasing volatility and fragility. Volatile and fragile. Sounds like me. Let's have a look at Shopify. Shopify moving higher in early trading, up about 1%. They are, according to the Logic, the business reporting website, they have cut, quote, a significant number of staff as a part of a major restructuring. That story was on the Logic yesterday. That's part of an overhaul to how the company works with external partners. The Logic is citing two sources, fairly significant layoffs because they have impacted staff across the partnerships division. Let's have another quick look at gold here, because gold has been setting record after record and it's moving higher in early trading. The spot price of gold, which is one way I like to do it because you get quirks with futures as they move towards expiry, etc. Spot price of gold, my screen is showing, is in record territory, 4,840 US dollars per ounce. So a new record for spot gold, at least if it can hold its current level. And we are seeing a bunch of precious metal stocks moving up today. Just ahead, we've been getting earnings from GE Aerospace and Procter & Gamble. We'll find out the investor reaction. Welcome to the second hour of the Open. Let's check out the big stories we are bringing you from the BNN Bloomberg newsroom. NATO's chief, Mark Rutte, says the breakthrough with US President Donald Trump over Greenland did not involve discussions of the island's sovereignty. Rutte says the talks were instead focused on broader security issues in the Arctic, quote, in a practical sense. The new framework for a deal was announced on Truth Social by the president, just hours after he arrived in Davos for the World Economic Forum. China's ambassador to Canada, Wang Di, is urging Ottawa to move fast and make progress on areas of collaboration. He's talking about the agreement both countries agreed to during the Prime Minister's visit to Beijing last week. During that visit, Carney and the Chinese leader Xi Jinping agreed to resolve a tariff dispute that had Beijing put levies on agricultural goods from Canada in retaliation for Ottawa's tariffs on electric vehicles from China. Toys R Us Canada is facing at least 7 lawsuits from landlords who say they're collectively owed over $30 million in unpaid rent and damages from the struggling retailer. Documents filed with an Ontario court last year claimed the toy chain failed to pay rent for several of the properties it occupied in 2024 and 2025, sparking lawsuits. The spaces were owned by landlords Rio Trin Properties and Callaway Real Estate Investment Trust. And there's a look at the TSX moving higher in early trading, boosted by precious metal stocks. And let's check out the U.S. markets. Where is the S&P? 6896, so it's not far off a record. Let me just check if it actually is at a new high water mark right now. Just under 6,900, and it's still down from its record high of just under 7,000 on Monday of last week. We got earnings from two prominent U.S. companies today as earnings season heats up. Procter & Gamble posted mixed results and cut its annual earnings forecast. And aircraft engine giant GE Aerospace came in with better than expected profits, thanks to rising demand for air travel. Let's get more from Justin Elliott, portfolio manager at Caldwell Investment Management. Justin, thank you very much indeed for joining us. Really appreciate it. Give us your take on the P&G earnings first, if you would.
Yeah, so P&G earnings, bit of a continuation of trends in recent quarters, where a lot of their growth has been driven by pricing, but they're losing share on the volume side. And if you think of P&G and their brands, stuff like Tide Pods, for example, they're typically more premium priced. And we know the dynamics going on in the US right now with the K-shaped economy, particularly pressuring the lower income consumer, means that those consumers are looking for more affordable options and they're what's called trading down or looking for more value-oriented brands. And so that's kind of taken some wind out of P&G's sales. And it's been, a negative aspect to the story regarding their organic growth going forward. So we don't really think that's going to change. We think, that lower end consumer will still sort of remain pressured in the near to medium term. And so they're going to struggle with their organic growth outlook. There were a few kind of bright spots, China returning to growth. That had been a challenge market as well. But we think overall, the beat was sort of driven by, and the outlook and guidance increase was driven by, for example, taking your tariff impact down or better results from foreign exchange, for example. We don't necessarily view that as a super high quality beat. We'd like to see that organic growth profile sort of pick up. And so for us, this was, not an outstanding quarter in any way. I think it kind of met a lot of investors' expectations. Mm-hmm. And so we're kind of seeing that in the stock price today. If you look at the valuation of the stock, it is sort of the cheapest it's been really in the last 5 years. That kind of reflects a lot of the dynamics that we talked about. But again, to kind of get a re-rating in the stock going forward, we think you need to see a pickup in that top line growth, which, we think is going to be challenging.
Broader, is this a stock that you would consider just buying and forgetting about? It was a classic blue chip holding for years in the United States.
Yeah, we still think there's a lot of brand value for their entire portfolio. Again, I think there's just better growth opportunities in the market. So if you perhaps have a 5-year outlook and P&G is able to sort of overcome some of these tariff headwinds, and bring that organic growth outlook up, I think the stock could re-rate over time. But in sort of the more near term, medium term, we just think those challenges for growth are going to be an impediment for the stock re-rating. So I guess we would call it a hold right now, unless you had a much sort of longer term outlook on the stock.
GE Aerospace, a very different company, and of course in a near oligopoly globally on aircraft engines. Is this a stock that you would be tempted to hold for the long term?
Yeah, so GE, their earnings had a couple nitpicks as well. I think one of the biggest issues that investors had were basically flat margin outlook for their engine division. And the dynamics there are that because of the supply chain issues that are impacting Boeing and Airbus, and that's impacting their ability to ramp production rates, that sort of trickles down the supply chain to suppliers like GE. They supply basically the major, the entire engine really for the Boeing 737, the 777, which is, their wide body aircraft. Mm-hmm. So when these new aircraft generations are introduced, the engines are often sold at a loss with the hopes of gaining the longer term services contract, right? The maintenance of that engine over time, which is where the margin comes from. As you push out the basically deliveries of those new engines, you don't get that service revenue coming in as quick as expected. And so that's sort of pressuring the margin outlook there. Just the losses as well to kind of really ramp up production and get it to the volumes that they expect. Now, that being said, we do see a very long pipeline in terms of new production coming from Boeing and Airbus over the next really 5 to 10 years even. They both got sort of 10-year backlogs to deliver new planes. And so we do see this as a very attractive market going forward. In the meantime, until they hit production, airlines are keeping older planes in production longer, and that's driving up service revenue, which I spoke to as sort of higher margins. So you've got a lot of offsets in the sort of near term, and then you've got a great long-term growth outlook. The sell-off today, I think, is really just more valuation driven for GE. But the whole aerospace kind of aftermarket supply chain and OE supply chain is trading fairly expensive, given that nice long-term dynamic. So, we would be a long-term holder of this stock. We like other stocks in that space a little bit better, which we hold in some of our funds. But we view the space as attractive overall.
You have a couple of stock ideas for us. Interactive Brokers. Just to remind us what they do, please, and what draws you to that name.
Yeah, indeed. So Interactive Brokers is a basically fully automated brokerage platform catering to retail and sort of more sophisticated investors. They actually just had their earnings yesterday, and they're really showing incredible growth in their user base, and it's driven by the tech-driven nature of the firm and what are called APIs. So they've been able to go into international markets and let financial firms in those markets basically plug and play into Interactive Brokers platforms. And that allows Interactive Brokers to get a much broader investor base sort of trading off of their infrastructure. And so, they've been growing these accounts at sort of 30% year over year for the last couple of quarters. They see that continuing going forward, but there's still very low penetration relative to the kind of amount of global sophisticated traders versus what they have on the platform today. It's something like 4 million on the platform today to maybe 60 to 80 million globally. So we still see a really long growth runway for them to go out there and capture that market share.
And just finally, another aerospace name, Howmet Aerospace, HWM in New York. Give us a brief rundown on why you like that company, please.
Yes. So Howmet is one of the suppliers that I talked about, sort of, down the supply chain. They supply a lot of the components that are in the actual aircraft engines. They're in the fuselage of the plane, sort of putting the whole body together. And they've seen really robust demand for their spare parts business. And that goes back to what I spoke about with airlines extending the lives of their current fleet because they're not able to basically swap out for new planes given the delays in productions. And so that's really driven a lot of growth in their spare parts business. We see that as durable, really, again, until that production rate kind of sustainably increases and a lot of the supply chain kinks are ironed out. They also have a very strong and growing business that's tied to sort of the power generation, which goes back to AI and the data center build out. So they supply the turbine blades that are used in gas turbines to power a lot of these data centers, as they look for alternate sources of energy, given how long it takes to connect to the main utility grid. And so very strong demand growth there. We think, again, that's very robust. You've got visibility there for the next sort of 5+ years. And we think, we like that outlook for that stock.
Thank you very much. As ever, it's great hearing from you, Justin.
Thanks for having me on.
Justin Elliott, Portfolio Manager at Caldwell Investment Management. Coming up, the Lululemon founder, Chip Wilson, has been a harsh critic of the company over the years, and he's having another good go at it this week. There have been latest problems with the company's latest Get Low collection. That's ahead. The outspoken founder of Lululemon, no longer, of course, running the company, is speaking out after Lulu launched a new line of products that received something of a backlash online. Let's get more from BNN Bloomberg's Lindsay Biscaya.
And he's no longer part of the company, as you say, but he is still the largest shareholder. And that's why, when we look at what Chip Wilson has to say, people take notice, including the company. So, yeah, we're talking about the Get Low line. And here's some pictures of it on Lululemon's website. Lululemon temporarily paused online sales of these products just this week from its website after customers complained that the collection was ill-fitting, sheer. And we know now that Lululemon did tell the Canadian press it was paused so they could better understand some initial guest feedback. So you can see here in some of these pictures, it's back online. It is available to buy, but it now comes with sizing tips, which some other items of clothing, most other items of clothing on Lululemon's website does not. So it's interesting to see that little added part on the Get Low line after some really harsh feedback online from people who were saying that these clothes just didn't fit right and they were see-through. And today, of course, we're getting more comments from Chip Wilson, as you mentioned, Andy, the former CEO and the founder of Lululemon. I believe we have his statement here. We can pull up a part of it. It's quite a long statement, but he's basically saying that this is a new low for Lululemon. He says he believed the company had lost its cool for some time. Now he thinks the company has completely lost its way. And he also says this is not the fault of employees. He blames the board for this and product quality testing, which he's questioning how much product quality testing is happening, because this is not the first time this has happened. There was a breeze through line back in 2024 that was also pulled completely after reports of unflattering fits.
Right. And I think I can't remember exactly, but I think people were complaining some of their leggings in the past, maybe those are too see-through as well.
Yes, yeah, so I think it's the breeze through, it's these ones now as well. And that it does come back to product quality testing, right? The materials and how they fit on different people. And of course, this company has been going through some tough times over the last year. I believe shares in 2025 dropped about 46% throughout the year of 2025. They're struggling looking for a new CEO now after the current CEO stepping down in January. So, yeah, it's interesting to see Lululemon. I mean, they're up today, but they were down yesterday.
Maybe we could just throw up a 10-year chart if we have it, because as you know, they walked on water for a long time.
They did. Yeah. And another part of that, over the last 10 years, I mean, look at that. Over the last 10 years, competition became more stiff, right? There's many other companies that are now selling athletic wear that rivals Lululemon, and also less people are wearing leggings. Jeans are back in. So there's a couple of different factors here, but also, a lot of people that I've heard from say that Lululemon isn't quite what it used to be in terms of quality.
Oh, that's interesting. They are still huge in China, I believe.
Yes. Yeah.
That's a massive market, but obviously,
a big market.
Yeah, but you want to hang on to share in North America as well.
Yeah, as a Canadian company founded in Vancouver, you kind of want that pride of being a Canadian company too, especially right now. But
yes, that's right. It's a good point. Yeah, it's fickle though, that
it is.
Apparel game.
It is.
Thanks very much, Lindsay.
Thanks.
Lindsay Biscaya. Okay, coming up, we are going to zero in on the Canadian ETF market. We'll get Mackenzie's outlook for the market, the ETF market in Canada this year. Time for the ETF report. According to Mackenzie Investments, Canada's ETF market is one of the fastest growing globally, with assets topping $700 billion last year, up nearly 38% year over year. Let's bring in Prayarna Matthews, VP of ETF Product Strategy at Mackenzie Investments. Thanks very much. What trends jumped out for you last year? What was the big story?
Thank you for having me. And just to clarify, $700 billion in assets here in Canada alone. The ETF industry across the world is now north of $20 trillion. And as a reminder for everyone, ETFs were created right here in Canada 35 years ago. So we have seen a tremendous amount of growth in ETFs here, of course, in Canada, but certainly also globally. And investors are voting with their dollars. They're voting to invest through the ETF vehicle. ETFs are becoming more than just passive tools in portfolios. They offer a lot of transparency benefits. They're easy to trade and rebalance in a portfolio, and more products are available. More active ETFs are available and of offer to investors. So it makes it a lot easier to manage your portfolio effectively if you're choosing to use ETFs as your preferred vehicle.
Mackenzie has long been one of the big players in Canadian mutual funds, but you have found a way to have advisors work with ETFs. Now, how is that? I mean, mutual funds, we know, traditionally carry commissions. They would pay trail fees. How does the advisor get remunerated if he or she is getting investors to invest in ETFs?
Advisors have been evolving how they are servicing their clients, the value that they are offering to their clients over the years, and the tools that they are using to help manage money for their clients is also evolving, right? So more advisors in Canada are actually choosing to use ETFs, preferring to use ETFs as part of how they're delivering their value of wealth management to their clients. So increasingly, we're seeing more advisors moving to fee-based models, where they're compensated at a fee level at the overall portfolio level. So unlike previous days of mutual funds and transaction-based or commission-based structures, those days are increasingly going away, and you're seeing more advisors moving to a fee-based model. And ETFs just become very easy for those types of advisors to be able to manage their clients' money effectively, to be able to rebalance, redeploy as market conditions change, move their portfolios around a lot more effectively.
That's interesting, because the old mutual fund commission structure was so complicated. And do any ETFs pay trail fees, though? Is that a model in the industry?
It is not. ETFs are very easy. They're transparent. You understand the fee that you are paying. ETFs typically have, of course, a bid and an ask, like stocks. So you're trading them on the exchange, and then you're transacting at that market price, and that's ultimately what shows up in your portfolio. There's no other additional fees or expenses. Most ETFs in Canada don't charge administrative fees, as an example. So that level of clarity, transparency, especially in our environment of greater regulation, particularly in the advice channel, we're seeing regulations like CRM3, which are driving for more transparency of value and fee for investors, increasing ETF usage as a result of that through advisors. So ETFs have just become very great portfolio management tools that are even more efficient than mutual funds.
Can you give us a ballpark figure on how much Mackenzie has in ETFs? I don't think you regularly disclose that, but can you give us any kind of an estimate?
Absolutely. We've just surpassed $25 billion on our ETF platform here at Mackenzie, and we're just shy of our 10-year anniversary, which has been very exciting to see that growth. Like I said, the advisors that we work with on a regular basis are increasingly looking to the ETF market. And as a longstanding Canadian asset manager here in Canada for north of 58 years, we want to continue to service our clients the way that they want to be managing money for ultimately our end investors. So ETFs undoubtedly is a part of that portfolio construction story moving forward.
One of your big funds from my Bloomberg screen anyway is the Mackenzie US Large Cap Index ETF, symbol QUU. Is that up there among the big products? But Bloomberg says about $5 billion.
Yes, absolutely. So a lot of investors, advisors don't realize that we are an all-encompassing ETF provider here in Canada. We certainly have a long-standing legacy and track record in active management and have brought that to the ETF market through active ETFs. But we also have a pretty wholesome or holistic passive or index shelf here in Canada as well, all made for Canadians by Canadians. It's a very strong message we build for the Canadian investor here. And so we do have some very large passive ETFs as well on our platform that are used by individual investors, advisors, and institutional investors alike. And
what are your biggest product categories, would you say, in ETFs right now? Among your advisors and retail investors, what are the types of ETFs that they have the most money in?
Yeah, just given what we are seeing in the world and what we have been seeing in the world, we'll say for the past 12 to 18 months, there is that the deglobalization narrative, the diversification focus is undoubtedly of paramount importance to advisors in Canada and investors in Canada. So we're seeing more interest in allocating outside of North America, more interest in allocating to products like our international equity ETF ticker MIQE, more interest in even looking at alpha opportunities in the U.S. market where it is so incredibly tough to beat the S&P 500. So looking at long-short strategies like our alpha extension ETF ticker MALX, these are areas where more investors are turning to say, if I'm looking for alpha, if I'm trying to drive more value and return in my portfolio, and it's becoming harder to find those as easily now, I need to turn to areas where maybe I haven't been as focused. Another mention I'll just quickly point out as well is in the Canadian market. While Canadians love investing in Canadian equity, for the most part, the average Canadian is actually underinvested when it comes to the resources sector. And you're hearing this and seeing this in macroeconomic commentary from various economists here in Canada. The opportunity in the resources space, I think we're at a pivotal moment here. And so for Canadians to be able to access that exposure, we've brought that to market in what we call our core resources ETF ticker MORE. These are definitely some areas of interest for advisors and investors right now.
Prayarna, thank you very much. Prayarna Matthews, VP of ETF Product Strategy at Mackenzie Investments. Shares in Allied Gold have soared about fourfold in the past year. We heard from the CEO. NATO Secretary General Mark Rutte says talks with U.S. President Donald Trump on Greenland focused on Arctic security and not sovereignty for that Danish territory. Rutte says the breakthrough that President Trump is pronouncing centers on practical cooperation in the region. Trump says that a new framework for an agreement was reached while he was in Davos. Vancouver-based General Fusion is set to go public after filing for a NASDAQ listing through a merger with Spring Valley Acquisition Corp. This is the fusion energy company that is working on this energy source that has eluded the scientists for decades. This stock will trade under the ticker symbol GFUZ, and the deal apparently values the company at about $1 billion US. General Fusion develops magnetized target technology for carbon-free power. Shares in GE Aerospace down after the company's outlook fell short of expectations. GE Aerospace recently forecast annual profit above estimates driven by strong demand for aftermarket parts and services. Airlines are expected to prioritize maintenance spending due to aircraft supply constraints. Demand, though, for new aircraft continues to outpace supply as airlines seek to capitalize on robust travel demand across multiple regions. And North American markets trading higher amid relief that U.S. President Donald Trump has backed down from his threats implicitly to seize Denmark if he had to. Just checking in on the TSX, it's still a little bit shy of Monday's a record high close. You can see the S&P 500 also higher, just short of its own record high. Shares in Allied Gold up around fourfold in the past year, easily outpacing the gain in the TSX Global Gold Index. This company has a big mine in Mali, and it's nearing production at its Kurmuk gold mine in Ethiopia. Canaccord sees the company's overall output rising above 500,000 ounces this year, up 45% from last year, and hitting 660,000 ounces in 2027. We heard from the Allied Gold CEO, Peter Moroney.
Particularly in jurisdictions that want to encourage mining. Ethiopia certainly is that, but has not had historical development of mines, certainly not large-scale mechanized mines. We have to be sensitive to that, and we have to say, let's take a little bit more time to make sure that the engineering is right, that the procurement and supply chain is done as efficiently as possible, that we've worked with local communities, with local governments. We took a little bit of that extra time at the beginning of this when Allied went public. in September of 2023. I said we'll take an extra 6 months to 9 months to put all of those things in place. I'm happy to say that the result of that is that we're now very close. By April, we start commissioning this mine. And by the third quarter, we will be in production.
And you're blessed, apparently, that the nearest settlement is quite a few kilometers away, maybe 8 kilometers away. So you didn't have to resettle people?
Well, we did not. Now, there are local communities. We will be hiring locally. That's a very important practice of ours. It's part of the policies of this company. But there are local people. We will have a camp at which they stay. But you are correct that there are not local communities. But frankly, there's support for this mine and there's support for mining in the country. And that has to be said as well.
So your production next year, according to Canaccord, could hit about 660,000 ounces between, your two biggies are Mali and Ethiopia. Does that sound in the ballpark?
So part of what we've been doing for the last couple of years, since again going public, just a little over 2 years, is stabilizing the existing operations, spending some capital on stripping in the case of the Côte d'Ivoire mines, finding new ounces of oxides. Sadiola is transitioning from an oxide mine to one that processes slightly harder rock, fresh ore. But it's interesting because that mine has already produced close to 9 million ounces. But as it transitions, we have more than 10 million ounces already in inventory, and that number is likely to continue to grow. We've made discovery of new oxides, but we've also completed the first phase of a 2-phase expansion at that mine that ultimately takes it to 350,000 ounces per year. That first phase and some of the other optimizations and the discovery of the oxide ounces to supplement our production is important because it stabilizes that operation for certainly the next handful of years at least 200. We estimate 200 to 230,000 ounces per year. Now, this is a mine that, as it transitioned and as it was coming to the end of the mine life of its oxides, in 2023, it produced barely 170,000 ounces. Here we are now producing in the order of 200 to 230,000 ounces, and that in itself is a very positive movement on that operation. The second phase will allow us to process more of that fresh ore through that plant, the result of which is that the production platform is expected to be closer to 350,000 ounces, with, of course, a further improvement to its costs.
Now, Mali, of course, run by a military junta, and Barrick has had trouble there. It looks like they've resolved a dispute with the government. You signed a deal, I believe a 10-year deal in late 2024 with the government. Is everything copacetic there, or are you in further talks with the government in Mali?
Well, we took an approach, Andrew. It's interesting because the approach that we took, not dissimilar to many of the things that in the predecessor company that this management ran, Yamana Gold, we did in South America, recognizing what the government was looking to achieve, the creation of a mining industry rather than just companies coming in to extract. We took a reconciliatory approach in 2024. We entered into a protocol agreement. We received our permit extension for that 10 years to which you refer. And we've been in dialogue with the government of the country on what else can be done on our part and on their part to further improve the mining situation in the country. Look, let's face it, that Birimian belt on which this mine is located is one of several mines. And I can't think of a place where you can find a handful of mines that produce between 200,000 ounces per year and 500,000 ounces per year. So this is prolific. It is an exceptional precious metals mining place. I believe that the government of the country recognizes that. They're trying to find a way to provide more take on the part of the state, while at the same time also encouraging mining. We've been in dialogue on the ways that could occur. We will continue to be in dialogue. I think it will lead to a positive result.
Peter Moroney of Allied Gold. Coming up, hot picks in gaming and gambling, including a sports betting data specialist with support from the NFL. That's ahead. Let's get to some hot picks. This time we're looking at the gambling and gaming industry. Our guest has Genius Sports, a betting data specialist, as a top pick. We're joined by Jordan Bender, Director of Gaming, Online Gaming, and Gaming Technology Research at Citizens. Thanks very much for joining us. It's a hot area and an exploding industry. Tell us what Genius Sports does and why they've caught your eye.
Yeah, it's good to be here. Thank you. So Genius Sports is the picks and shovels of the industry. So the online sports betting and iGaming industry in the United States and up in Canada look extremely strong. Fundamentals look good. And this is the back end, what drives a lot of these sports books. So it's a company that's growing revenue 20% plus. It's growing EBITDA at the bottom line. Margins are expanding. And we think this is kind of the formula and the setup in 26. And investors are looking at this space going, how do we play the sports betting industry? And we think this is the safest way. The stock is pulled back here. There's prediction market, a lot of prediction market talk within the industry and the overhang. We think Genius has been unfairly valued because of this overhang. So on the pullback, we think 26 is going to be a beat and raise story. So they put out 28 targets back in September at their investor day. As we progress through the year and the company beat and raises, we think that's what's going to lead to share appreciation and have valuation go from about 11 times today up to our target around 17 times EBITDA.
And sorry, Jordan, you referred to an overhang there. Can you just clarify that?
Yeah, there's just a thought out there that prediction markets are going to cannibalize the legal online sports betting industry, and a company like Genius wouldn't be needed in that case.
That's amazing. So the prediction markets they're shouldering their way into the sports betting market?
Yeah, and they're going through a different type of framework in the U.S., which is how they've kind of exploded over the last year. And essentially, because it's not truly traditional sports betting, if the industry starts to move towards prediction markets, you won't need a company like Genius, or that's at least what the bears in the industry are talking about. As of today, we think that's overblown. We think it's not true. And what the data is telling us is that cannibalization impact is not anywhere close to how these stocks should be trading.
That's interesting. And I think you touched on this, but the NFL relationship you think is extremely valuable for Genius.
Yeah, and really what investors come to us talking about is how is Genius integrated into the NFL? And this is what will essentially make or break this company. They have the rights to the NFL to sell that data to the sports books. So, they have the sports betting component and they have the media integration component. So they're helping advertisers advertise across the NFL. And with that, the NFL is a growing sport in the U.S. It is dominant, and we think it's a derivative play off of the health of the NFL here.
Let's move on to DraftKings, another massive player in sports betting, and they have a partnership with ESPN.
Yeah, so Genius, the back end part of the ecosystem, DraftKings, the front end, the B2C companies. So DraftKings, in our view, as it sits here today, it looks like they're starting to gain share. They are the first, given the day, the first or the second largest sports betting company in the United States and Canada. From their position, because we think they have the partnership with ESPN that started December 1st. We think they're starting to take some share. That leads into a first quarter with easy comps, and then into a middle part of the year, which is a sports calendar that's less volatile. Now that we exit the NFL. So from a setup perspective, we like DraftKings here with the valuation where it's trading again. It's been caught up in the prediction market overhang for them. It actually should be a benefit. They launched their own platform, and we think they're going to ultimately, it's going to be a net positive.
That's really interesting. So Kalshi would be one of the big prediction markets. Are they, who regulates them anyway? Is it a bit of a gray area?
As of today, it's technically legal. They operate through the federal level and the CFTC. Now, there's this huge ongoing debate of how legal is it for them to offer sports contracts. That's why they've exploded. They've kind of figured out a way to get into all 50 states across the United States and offer a sports betting type product. Ultimately, it's going to bounce through the courts and ultimately end up in the Supreme Court, and that's the ultimate decision maker right there.
And then your final idea here is Churchill Downs. We're talking about much more than racetracks here, though.
Yeah, everyone might know Churchill Downs for the Kentucky Derby in May, but as of today, that only sits about 15% of their earnings. In recent years, they've invested a lot of money into the other part of the business. So they have casino type offerings. And the setup for the stock is it's traded flat for the last 5 years, but they've gone through a massive CapEx cycle, M&A cycle. And as we sit here, that'll start to pull back for the first time in a long time. As CapEx falls, we think this company is going to start producing a lot of free cash flow, and that's going to help the balance sheet of the company. And we think that's what investors are going to want here from a bellwether, a very clean company within the gaming space.
And just tell us, what else are they doing? They're involved in electronic roulette. How does that work? Are these machines or is it online roulette?
Yeah, so about half of their business is actually traditional brick and mortar casinos. So like you would see in regional markets or in Las Vegas. There's another piece of it that they offer gaming in a slot machine that has different back end economics. We like to just tell people it's casinos. So the vast majority of their business actually sits within brick and mortar tables and slot machines.
Thanks very much, Jordan. And it really, what a landscape, eh? We're tight for time, but I mean, the explosion of online gaming and in recent years, the willingness of sports leagues to actually embrace gambling.
It's a wild industry, and it's something new every day.
Jordan, thanks very much indeed. Really appreciate it. I hope you can come back soon. Jordan Bender has been our guest there, and yeah, it really is incredible how governments have, over the past decade or so, just loosened the control on gambling. Up next, Gavin Newsom, the California governor, says Trump is trying to suppress dissent. We'll be right back. California Governor Gavin Newsom says he was denied entries to an event on the sidelines of the World Economic Forum after pressure from the White House. He had been invited to speak at an event at the USA House, a venue showcasing US companies. But his office said in a post on X, aka Twitter, "Is it surprising the Trump administration didn't like my commentary and wanted to make sure that I was not allowed to speak?" Newsom accuses the government of authoritarian tendencies. He spoke during an onstage discussion at the WEF. Let's have a quick listen.
I was going to speak last night. It was a well-established event at the USA House. Simple conversation, discussion. After Trump's speech, they made sure that I didn't. They made sure it was canceled. And that's what's happening in the United States of America. Freedom of expression, freedom of assembly, freedom of speech. It's America in reverse. They're censoring historical facts. They're rewriting history. They're censoring books, 4,340 books, libraries, and in schools, banned in the United States of America. You're watching institutions. Any institution of independent thinking is under assault and attack by the Trump administration. You're seeing what's playing out in the streets of American cities, what played out in California, the second largest city in the United States of America. 4,000 National Guard were federalized. 700 active duty Marines were not sent overseas. They were sent to my largest city in the state of California. Masked men. Guy Greg Bovino, dressed up. It's as if he literally went on eBay and purchased SS garb. Greg Bovino. Secret police, private army, masked men, people disappearing, quite literally, no due process, windows being smashed, seatbelts on, being, literally just sort of cut off, people dragged in the streets, kids separated from families, knocking on doors, racially profiling American citizens. So is it surprising the Trump administration didn't like my commentary and wanted to make sure that I was not allowed to speak? No. It's consistent with this administration and their authoritarian tendencies. Forgive me. These are objective facts.
President Trump announced that there's a framework in place for a deal on Greenland. That's after his wide-ranging address to the World Economic Forum. Trump says this agreement gets him everything he wanted. CTV's Washington bureau chief Joy Malbon filed this report.
The U.S. president arrived by helicopter, appearing before business and world leaders, stepping up his demand to own Greenland.
So we want a piece of ice for world protection, and they won't give it.
The president falsely claimed the U.S. owned the island, defending it from the Nazis during the war. It's Danish territory, but Trump wants it back. And now he's backing off his threat to seize the Arctic island using U.S. military might.
We probably won't get anything unless I decide to use excessive strength and force where we would be, frankly, unstoppable. But I won't do that. Okay? Now everyone's saying, oh, good.
That hasn't stopped Donald Trump's Greenland ambitions, calling for immediate negotiations with NATO allies to annex the island. He threatened tariffs.
We have no interest in picking a fight, but we will hold our ground.
The European Union hit back, suspending ratification of a massive trade deal with the United States. But after discussions with NATO Secretary Mark Rutte coming to Donald Trump's defense.
And when it comes to the Arctic, I think President Trump is right. Other leaders in NATO are right. We need to defend the Arctic.
Everyone looking for an off-ramp to this crisis. Donald Trump posting on social media he won't impose tariffs now on European nations, reaching a deal, he says, with NATO. We have formed the framework of a future deal with respect to Greenland and, in fact, the entire Arctic region. The solution will be a great one for the United States of America and all NATO nations.
It's the ultimate long-term deal. And I think it puts everybody in a really good position, especially as it pertains to security and minerals and everything else.
Trump doesn't say if the U.S. will own Greenland, and no one knows what this deal means. But after being pushed to the brink, a sigh of relief.
If the deal here is that the United States can build up our military forces on Greenland, and there's a 1951 agreement between the United States and Denmark that prohibits it and permits it and welcomes it, that might be the off-ramp.
So from the brink of a potential military invasion to a possible trade war with Europe, some say Trump may have miscalculated. Others say there's now a future security deal in the Arctic that reassures this president. Joy Malbon, CTV News, Washington.
Let's check in on the equity market. Before we go, let's have a look at the TSX. You can see moving higher. Some interesting companies actually hitting record highs. Cameco, CCO, if we can put up a 5 or a 10-year chart, in record territory once again. Of course, there is optimism that America will finally actually get round to building more nuclear plants. There are none officially on the drawing board right now. A couple of companies, of course, have expressed interest. We've also got BRP hitting its high. DOO is the symbol. The recreational vehicle company hitting its highest in at least a year. There's a look up 40%. Investors optimistic that people will be spending on those adult toys. Another name, prominent name, hitting a record high today, Franco-Nevada. Maybe we could pop up a 5-year chart there. FNV. The company, of course, was plagued by the troubles of that giant mine in Panama, the Cobre Panama mine. It has a pretty heavy exposure to that. And the hope among investors is that that mine will get back into production. But Franco-Nevada surging today. Let's maybe have a quick look at a 5-year chart for the TSX. It's not quite at record highs, I don't think, but that's a moving target right now with the way stocks are moving up. No, so we've got 33,074, and we closed at 33,090 on a Monday. So just let me give you a year to date. At one point this week, the S&P 500 had wiped out all of its gains for the year. It's now up about 1%. Toronto beating the S&P once again, up 4.3%. Thanks very much for watching our show.